Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I'm going to talk about one of my favorite subjects. Actually, I don't know if it's one of my favorite, but it's a good subject, and that is deregulation. I would say that with all the chaos going on right now in government, let's just say, the tariffs, there was a big spat between Trump and Elon Musk, and just all the craziness with the FBI and what's going on with releasing of certain information. And anyway, just there's so many things that capture the headlines, but what I think's been lost a little bit is the amount of deregulation that has happened just here in the first 150 days of the Trump administration. And some of it is specific to the mortgage industry, and that's what I want to talk about. Now look, I'm not necessarily, I joke about deregulation being one of my favorite things. I think that we're in an industry that definitely needs good regulation. There's no question about that in my mind. So please don't get me wrong. But sometimes when you have lawmakers who know nothing about our industry making regulations, and you think back to 2010 and the Dodd-Frank and all this stuff. I mean, a lot of that stuff was very well intended, and something needed to happen because the industry was a bit out of control at the time. But let's be honest, I mean, when lawmakers are making rules on industries they don't understand, they typically have these huge bills, no time to review the details, and these things get passed because there's public outcry for regulation. Look, there's unintended consequences. There's no question about that. And at some point we have to go back and we have to look and peel back the layers of the onion and say, okay, are all these things that we put in place really working as intended? So when I think about deregulation, I think about a more methodical approach to, okay, what have we put in place that is not serving the consumer, that is burdensome for the potential industry, and what are things that we can now change that would not, directly make things a lot worse, but could make things, better for those involved. So anyways, that's what I think of when I think of deregulation. And so what I want to do is touch on a few things. Now, what people may not know is, and I think it's because of all the other exciting stuff that we hear about in the news, is how much deregulations happened in the housing industry alone. So whether it be HUD, FHFA, the CFPB, we've talked about the CFPB on this podcast multiple times, but all of these changes are significantly lowering the burdens for the mortgage industry, and there's no question about that. And most of them, I would say, in some cases, are removing burdens for builders and for homeowners as well, ultimately, right? As some of these things will drive down costs. So let me give you an example. I didn't know about these, but one of them was there was a rule put in place that raised the floodplain rule to where you had to be, when you do an elevation certificate, you have to be, above the flood zone. Well, they made it to where you had to be 2 feet above the flood zone. I think the previous rule might have been 12 inches, might have been 1 foot. Now it's 2 feet. So think about all the houses that were intentionally built with an elevation certificate to be above what would need flood insurance. And now all of a sudden they all require flood insurance. This is a huge thing. And if you're in the mortgage industry, or if you're a consumer who is doing a refinance transaction, all of a sudden you're like, I've never had flood insurance before. Now all of a sudden I need it. Like, this is, probably unnecessary and burdensome for both consumers and for our industry. Well, that is gone. That's been repealed and no longer there. There's been a lot of environmental building regulations that significantly increase the cost to builders and ultimately get passed on to consumers that have been pulled back. That's something that, we've been hearing that should happen for a long time. Some of these regulations got really out of control, all under the idea that this is environmentally friendly, but they're so burdensome when you think about implementing them into the building of a home. And I think that consumers should have the choice. Look, if you want to buy an energy efficient home, you should seek out builders that, put in the extra time, the extra insulation, the appliances that are going to give you that. But look, if you want something that's more affordable and that's not high on your priority list, you should have that choice as well. So this, in my opinion, is lowering costs and giving some choice back to the consumer. There was another one that I don't know a lot of details on this, but this is interesting. The 2024 bulletin that was put out that detailed the enforcement against unfair and deceptive practices. So how they were going to go after UDAP violations. And that apparently has been repealed. Now, if you think about all the huge lawsuits and settlements that have happened over the years, like you think about like Wells Fargo, Bank of America, some of these other large mortgage entities that had to pay a ton of money. A lot of them fell under UDAP. And so it sounds like in 2024, there was a bulletin saying, hey, here's how we're going to continue to push enforcement on UDAP. And that's been completely repealed. So all these things, the MBA president and CEO Bob Brokesmith had commented on and said that, these are all things that are very welcome by the mortgage industry. So I wanted to point them out because it's something that for me has been a little bit under the radar. Now, this last one, I should have put a teaser at the beginning about this one because then everyone probably would have stayed on and watched this. But there has been a recent notice regarding the altering of the LO compensation rule. So I'm going to refer to my notes here just a little bit. The CFPB sent LO comp and servicing rules to the OMB for review. And they're talking about possibly a full rescission of LO compensation rules. Like, can you imagine? Now, if you remember back, which I'm sure most people don't, but if you remember all the way back when they first rolled out LO compensation rules, they were quite egregious. And then there was some clarification made over time. So the question is, are they going to just roll back to that previous Federal Reserve kind of, statement, which said like, you can't charge any fees, you can't charge any, there's no origination. I mean, there's a lot of things in there that would have been very difficult to comply to. So then we got some clarification on how we're going to implement this, from the CFPB. Or do they just remove LO compensation rules altogether? Like there is no rule regarding LO compensation. And so this will be an interesting one to follow. It sounds to me like this has some legs, and everyone agrees that we need to, at minimum, revisit LO compensation rules to make sure that they're relevant for today's kind of landscape. Now, when I think back to 2010, when this stuff went into effect, the main reason for LO compensation rules was because during the ramp up 2005, 2006, 2007, the ramp up to the Great Crash, there was a lot of loan products available that not only were very harmful to consumers, but also paid a lot of money to originators if they were sold in a certain way. So like, for instance, you could give someone a negative amortizing ARM, and then you could put a prepayment penalty on that. And the longer you made the prepayment penalty, the more money you made as an originator. So clearly there was incentive for originators to push high risk products onto consumers. That was a thing. That's real. It was happening. And LO compensation rules, obviously made it so that could not happen anymore. But let's also recognize that those products don't exist anymore today. There is no prepayment penalties on, on most loans. There are some exceptions, typically on business type loans, investment properties, maybe some things of that nature, non-QM loans, etc. But none of your standard products or anything would have a prepayment penalty. So a lot of what was even available from a product perspective that loan officers were incentivized to push their clients into, those don't even exist anymore. So I think it's definitely makes sense to revisit this. And then you also look at the way that things are working in the broker world, right? So there's definitely a clear difference between banks, mortgage banks, and brokers when it comes to LO compensation rules. And I think there's been a lot of talk about the broker world and how loan officer compensation is managed or regulated, or frankly not regulated. Brokers are supposed to have their same comp set up under the original proposed rule, the exact same with every other lender. There's definitely some provisions that have been clarified that say that no, they can have different different lender paid comp levels with different investors. However, you do have to do an anti-steering disclosure that discloses the different options that are available to the customer that you routinely and customarily use. And I don't think there's a whole lot of adherence to that policy. And then now we got this whole other borrower paid compensation thing going on where the majority of lenders are doing borrower paid compensation. So now we're not even establishing up front what the amount of revenue is or the margin that's built into any loan. It's really it's just different on every single transaction that you do. All these things have created a landscape in loan officer compensation that I would say at best, you could say companies have figured out workarounds. I'm not here to debate the legality of them. I have my opinions, but I'm not an attorney. I'm not a regulator. So I'm not going to debate whether or not these practices are legal or not. But you cannot deny the fact that there is so many different nuances to the way that loan officers get paid in an attempt to navigate around some of the challenges that these LO compensation rules put in place. Even loans, like you can't vary your compensation based on loan product type, even though there's loan products, especially some of the state bond programs, things of that nature that bring in significantly lower revenue into the organization, but yet you still have to compensate a loan officer the exact same amount of money. All those things, seem like they should at minimum be revisited. And it sounds to me like we're in a place right now where that's very likely going to happen. Now, what is the result of that? I don't know. I would not be surprised if someone looked at all this and just said, do we even need LO compensation rules in effect? I don't know that we do, based on the products that are available today and kind of how the industry and the competition between investors actually works today. But time will tell. But nonetheless, this is something that we're definitely going to keep an eye on, guys. I was heavily involved in LO compensation changes when they took place because I was running a mortgage company at the time and, was very involved in coming up with, what are the compensation plans going to be? What's going to be allowed? So this is a topic that's kind of like near and dear to my heart. So I'm very excited to see if this gets any legs as they go through and revise or at least revisit this LO comp rule. There's also talks about the servicing rules. Like I said, I'm not going to get into that so much on this episode because I want to keep this as a bite-sized episode for you guys, but something to keep an eye on. I think a glimmer of hope. Now, what last thing I'll say, loan officers might be going, yay, that's awesome. That means, we can start making rebate on our loans again. Like, all the old school things. I'm just here to tell you, I don't think that's the way that this goes down. I really don't think that's the way that this goes down. Now, will there be situations if there was no LO comp rules where you might be able to make a little bit more revenue? Sure. But I also think that it would be a situation where, just like the brokers, right? One of the things that brokers, get some heat for is their ability to do borrower paid compensation, but oftentimes it's significantly lower than what they would have done with lender paid compensation. So this is loan officers choosing to reduce their compensation in order to give a more competitive rate to their borrower and win that transaction. So if you think back to 2006, 2007, we were talking about situations where loan officers wanted to push a borrower into a certain scenario, product, whatever, interest rate, prepayment penalty, in order to make significantly more money. what I see loan officers doing, which is still probably a violation of LO comp rules as written today, but almost every time I see it intended to give a better deal to the consumer. So how is that hurting the consumer? Now, does it create an unfair level playing field between banks and mortgage banks and brokers? I would argue that it does, but I would not say that it's being done maliciously to put the borrower into a higher risk product so the loan officer can make more money. Matter of fact, I would say it's the exact opposite of that. They are taking advantage of the borrower paid compensation exemption within that rule in order to give the borrower a lower cost and which ultimately would be lower compensation for the loan officer, but it does help them win more transactions. That's where the rub comes. That's where people get frustrated by it, because does it create an unlevel playing field? So anyways, you guys, lots to come on this. I'm going to stay on top of this one because I love this topic. I'm excited about it. And I'm curious to see how it all goes down. I'd be curious what your thoughts are. This would be a great episode to leave some comments down below and let me know your thoughts on what do you think would happen if LO compensation rules went away. Do you think this would be a negative for the industry? Do you think it'd be negative for consumers? Or do you agree with me that most times the challenge is that loan officers are willing to make a little bit less money to give a better deal to their customer to win that transaction? And who's being hurt by that? You know, I don't think that anybody is. That's free market as far as I'm concerned. So with that, you guys, I want to thank you for tuning into Market Shares. And I want to also thank you for letting people know. Share this with the industry. Let people know what we're doing over here at Market Shares. It really helps us out. And for those of you who are subscribers, as you know, we drop a new episode every single Friday at 10 a.m. Pacific time, and I'll see you then. Take care.